10, 9, 8, 7, 6, 5, 4, 3, 2, 1, 0.
Welcome back to Beyond the Ledger, where we break down the numbers, the narratives, and the nuances shaping today's tax and financial landscape. I'm your host, Shardae Layfield, and in this episode, we're diving into one of the biggest tax developments of the year, the One Big Beautiful Bill Act, better known as the OBBBA. This sweeping legislation touches just about everyone: individual taxpayers, business owners, executives, innovators, and manufacturers. From the return of major Tax Cuts and Jobs Act provisions to changes in R&D expensing, charitable giving, bonus depreciation, and even a new incentive that's making manufacturers rethink how they invest in buildings, the OBBBA is packed with updates that deserve a closer look. And to help us unpack it all, we're joined by Ben Bowers, Nina Desai, and Duwayne Sibley. Ben Bowers is a senior manager in Georgia licensed CPA in Bennett Thrasher's personal financial services practice. He advises corporate executives, business owners, family offices, and high net worth individuals on complex tax planning and compliance, with expertise spanning partnerships, S corporations, fiduciaries, and nonprofits. And next we have Nina Desai, a partner at Bennett Thrasher and a Georgia licensed attorney leading strategic initiatives within the firm's credit and incentives practice. She specializes in R&D tax credits, Section 174 compliance, and startup tax strategy, advising clients across construction, healthcare, manufacturing and distribution, and technology. And next we have Duwayne Sibley, the Cost Segregation Director in Bennett Thrasher's Tax Credits and Incentives practice, bringing nearly 2 decades of experience in cost segregation, tax incentives, and energy efficiency programs. He helps clients maximize value through optimized depreciation strategies, fixed asset and repair studies, identifying credits and deductions, and supporting audit defense. Thank you all for being here. I'm so excited to dive in. Thank you all.
Good to be here.
So let's just dive right on in because there's a lot of buzz around the OBBBA. So let's dive right in. So as we look at the sweeping impact of this bill, one of the biggest themes is continuity and stability for taxpayers. And a lot of the One Big Beautiful Bill focuses on extending provisions from the Tax Cuts and Jobs Act that were set to expire at the end of the year. Can you break down what's staying and what it means for taxpayers now that these provisions are permanent?
Yeah, so I can take this one. And yeah, thanks again for having us on. I think that, this bill was passed back in July. So to some extent, it's a little bit of old news for some people, but I think for a lot of taxpayers, they're still kind of figuring out, how it affects them. Especially as we kind of come towards the end of the year-end planning, figuring out, what they need to do to kind of optimize their tax strategy, any kind of moves they need to make at the end of this year as they're trying to kind of figure out the impact of the One Big Beautiful Bill. And I might refer to it as the OB3 as well, just to shorten it a little bit,
Great.
rather than saying the full name every time. But yeah, that's what a lot of tax practitioners are kind of calling it. So
Star Wars
yeah,
movie.
Exactly. So like you mentioned, a lot of this bill, the OB3, was kind of intended to extend a lot of the existing law from the Tax Cuts and Jobs Act of 2017. For a lot of folks, it's not necessarily kind of changing what their current status is from a tax perspective. It's just kind of, extending the current law. It's not necessarily providing new tax cuts, just extending things that were set to expire at the end of the year. So I think from kind of the individual tax side, the thing that most people would be interested in is the tax rates are staying the same. So current top tax rate is 37%. That's compared to the previous top tax rate of 39.6%. So, this is good news that is being extended. slightly lower tax rates. There also continues to be 7 tax brackets, which is pretty much in line with the historical norm. There's also a higher standard deduction amount that's been made permanent, so that's roughly double what it's been in the past. So I think what you're seeing as a result of that is a lot more taxpayers are taking the standard deduction rather than itemizing their deductions. I think the latest statistics we've seen are that around 90% of taxpayers are now taking the standard deduction. So I would expect that to kind of continue going forward. Couple other benefits, the 20% qualified business income deduction was made permanent. So, that's going to benefit your business owners, people who own pass-through entities like S corps, partnerships, sole proprietorships. They all get a benefit there. The estate and gift tax exemption was sort of made permanent at its current levels. Some people were worried that this was going to be cut in half at the end of 2025, but again, the OB3 kind of extended that. So the current level is around $14 million. That's sort of the amount of wealth that you can die with and not be subject to the federal estate tax. And that number is going to be bumped up to $15 million for 2026. So a lot of kind of positive changes, or not changes, but extensions. I did just want to mention a couple of the disallowances as well that were made permanent. So personal exemptions, that's a deduction that is no longer available to individuals. So you used to be able to deduct like $4,000 roughly per person, kind of including yourself and dependents on your tax return. You no longer get that. You also no longer get a deduction for miscellaneous itemized deductions, which includes things like investment fees, accounting fees, things like that. So most of the extensions were positive, a couple negative ones, but I think, kind of the main thing is there's just kind of some clarity and, stability as far as tax planning now, and people know, what to expect kind of going forward.
Thank you, Ben. Okay, so many taxpayers have been closely watching changes that could affect their annual deductions, and one update is getting a lot of attention. And one of the biggest headline changes is the update to the state and local tax deduction cap. What exactly changed, and who is most likely to benefit from the expanded deduction?
Yeah, so this is another big one just because, again, going back to that Tax Cuts and Jobs Act from 2017, this was what I would call, one of the more controversial parts. There was a new $10,000 cap on the deduction for state and local taxes, or SALT, that was a part of that law. That cap still continues to apply, but it has been expanded for some taxpayers for tax years 2025 through 2029. Certain taxpayers will be eligible to deduct up to $40,000 in state and local taxes instead of $10,000. So again, this is an itemized deduction. It's your things like, state income taxes, state and local real estate taxes. So it affects a lot of taxpayers. The kind of caveat here is that there is an income phase out. So once your income exceeds $500,000, you're going to start getting phased down from that $40,000 deduction back down to the $10,000 deduction. So for, your ultra high income taxpayers, they really aren't going to get a benefit from this kind of expanded cap. So, thinking through who this does benefit, it's going to be people in your kind of high tax states, think New York, New Jersey, California, Illinois. Maybe they're making $300,000 to $500,000, kind of in that range. Those are going to be the people that really benefit from this change.
Thank you for the insight. So, and charitable giving is an important part of tax planning for many households. And this bill introduces some meaningful shifts. So the bill also makes notable changes to charitable contribution rules. What's different now for taxpayers who itemize deductions and those who don't? Are there any planning moves people should be thinking about before the end of the year?
Yeah, so I'll touch on this one as well, since it kind of deals with individuals for the most part. There are a couple of changes for individuals. So one of them is actually favorable or kind of a positive change. The other one is unfavorable. So for those taxpayers who don't itemize their deductions, so who take
Mm-hmm.
that higher standard deduction that we talked about, typically they would not be able to deduct charitable contributions. But there is a change in the OB3 starting in 2026. You can now take a small kind of charitable deduction on top of your standard deduction. So even if you don't itemize, you can deduct up to $1,000 if you're single, or up to $2,000 if you're married. So,
Mm-hmm.
just thinking kind of through how that's going to impact people, maybe some individuals who didn't really have an incentive to give charitably before, other than, it just makes you feel good, and is kind of a good thing to do. Maybe this kind of gives them the extra push they needed to make a
Right.
charitable contribution. Again, this isn't effective until 2026, though.
Okay.
So you don't get a benefit kind of for contributions made before the end of this year. On kind of the other side of the ledger, for individuals who do itemize, they're actually going to kind of get a small haircut on their deduction, again, starting in 2026. So how it works is, effectively, you have to reduce your charitable contribution deduction if you itemize by 0.5% of your adjusted gross incomes. This isn't a huge or kind of devastating impact, but for a
Mm-hmm.
lot of large donors and maybe very high income earners, it could make a significant difference. Imagine if you have $10 million of income, that's going to wipe out 0.5% of that, which is $50,000 of your charitable contribution deduction, kind of gets wiped away. So again, that's in 2026, though. So from a planning perspective, if you do itemize, I would say, if there's a possibility to kind of accelerate your charitable deductions into
Mm-hmm.
2025, maybe you've made a 3-year pledge or something, and you can go ahead and just accelerate it into 2025. I would say do that if you do itemize, so you won't be kind of hit with this, 0.5% of income reduction in 2026 and future years. On kind of the other side of the ledger, if you don't itemize and you want to take advantage of, the new kind of $1,000 or $2,000 deduction that's
Mm-hmm.
available, if you take the standard deduction, I would say, maybe if you're thinking about doing a gift before the end of the year, just wait a couple weeks, do it in 2026 when you can actually kind of get the benefit for it.
Gotcha. A lot happening for 2026. So, another area that has sparked a lot of interest involves workers and employers, especially those in the service industries. So, there's been a lot of talk about the new deductions for tips and overtime. So, how do these provisions work and who qualifies to claim them?
Yeah, so the tip and overtime deductions, those have probably gotten or a lot of the headlines kind of in the media coverage of the
Mm-hmm.
OB3. They apply to, a lot of people. A lot of people are in those jobs that receive tips and or where they get overtime pay. So, these tax cuts are more targeted at kind of your lower to middle income kind of hourly workers, and they actually phase out once you exceed a certain amount of income. So, yeah, they're really not meant to benefit, your very high income earners or kind of business owners or investors, that type of thing. Um, so, kind of one of President Trump's campaign promises was this no tax on tips or overtime.
Mm-hmm.
Kind of thing that he was promising. That's not exactly what this is, because it's not a complete exclusion, but you do get a substantial deduction for tips and overtime pay. So For qualified tips, it's up to $25,000. And that is basically you can just, reduce your taxable income by $25,000 of qualified tips that you receive, as long as you're in an industry where that's sort of the standard. So, think restaurant servers, hotel staff, rideshare drivers, sort of industries where it's customary. This doesn't apply to like accountants or, lawyers where you're typically not receiving tips. You
I
can't
don't want to restructure my income so I can write some.
Yeah,
I know.
Right, Duwayne?
No tips here, unfortunately.
unfortunately, yeah, you can't sort of restructure to get some tax-free income there. But if you are in those industries like, bartender, restaurant worker, you can exclude up to or deduct up to $25,000. The overtime pay deduction works in a similar way. It's a little bit more limited. It's only a $12,500 deduction for single individuals, but you do get the full $25,000 for married individuals. I think the important thing here is that it only applies to kind of the 50% premium portion of like the time and a half that you get paid for overtime. So it doesn't apply to kind of the full amount of your overtime pay, just that 50%, premium over and above what you would normally get paid. Again, there are income limits on both of these. They start phasing out at $150,000 of income for single individuals, $300,000 for married individuals. Again, kind of not intended to benefit high income individuals. These are also temporary in that they're only available for tax years 2025 through 2028. So, you kind of have that 4-year window unless it does get extended in the future. So you have, that time frame to take advantage of it, and then it's set to expire at the end of 2028.
Okay, so now shifting toward business incentives, and R&D continues to be a major focal point in this legislation. What are some of the changes available under the OB3 as it relates to R&D expensing?
You don't want to say the full act, Shardae? I know.
I will, but Ben kind of made it cool.
No, I love it. I've heard like many different variations. I think OB3 is the most I've heard of the shortcut of the abbreviation for the name, which I like that. So thank you, Shardae. Happy to take on that question. So I think it's helpful if I kind of start with the history of, so the code section that governs R&E expenses is Section 174. So prior to the enactment of the Tax Cuts and Jobs Act, all of your research and experimentation or all of your R&E expenses could be immediately deducted. And then beginning with the Tax Cuts and Jobs Act, there was an amendment made to that code section that required that you capitalize and amortize all your R&E expenses over 5 years for your domestic expenses and 15 years for your international expenses. And I think I might have mentioned this before, but most tax practitioners never really thought that that amendment to Section 174 would really ever take effect because it really is just really bad public policy and it goes against the entire incentive behind promoting R&D in this country. And so there were bills that were kind of, put out there that were, kind of on the path to making its way to the president's bill, but they never passed that would have changed that. And so practitioners have been waiting, and I think clients and people in the industry have been waiting for a fix for a very long time. And the good news is that we do have a fix, and it's a permanent fix that now, so beginning in 2025, you can now deduct all of your domestic expenses that are attributable to R&D. Now, your foreign expenses must continue to be capitalized and amortized over 15 years, but at least that still goes to the public policy reason behind R&D. It's still about promoting R&D in this country. So that's really good news. We have a lot of clients that are really excited about it and have been waiting for this fix for a while. So we've been getting a lot of questions about it and how this impacts them. We've been doing a lot of modeling about, projections for what that's going to look like for next year. And even with that, there are also some transitional rules that have come into place about R&D expensing. So if you have been capitalizing and amortizing those R&D expenses for 2022 through 2024, you actually have a few options that you can actually accelerate your unamortized R&D expenses fully in the 2025 year or over 2 years and split it evenly between 2025 and 2026. So it sounds really great in theory, but we're also talking to our clients to make sure that we're not accelerating too much in one year. We're trying to model what that looks like, right? Because obviously we're just focusing on the R&D provisions, but all of this also impacts other aspects of the tax return. And then if you're a qualified small business, you have the option of going back and amending your 2022 through 2024 tax returns to immediately deduct those R&E expenses. So we're talking through a lot of options with our clients right now, trying to model out what makes the most sense. For our clients that are potentially expecting a refund, they obviously are more inclined or more excited about the possibility of amending, but there's a very short window for amending for the 2022 tax year. You have up to 3 years. You have until July 6th of 2026 to file that amended return, or up until the statute of limitation runs out. So for any clients that have filed on time for 2022, they're actually getting pretty close to that. And so we're telling them to start making that decision and speak to their advisor sooner rather than later. But also when you talk about amending tax returns, there's also the added cost to expensing. How many layers of returns do you have to amend? And then when do you actually expect that you'll actually see the benefit of that amended return? Some clients, even if they would expect a refund, leave the returns as is and potentially focus on future years. So there's a lot there, but a lot to be excited about, a lot that our group is really excited about, and really happy to share this information with you today.
Yes. Okay. Section 174 has been a challenge for many companies over the past few years, but creating uncertainty for businesses investing in innovation. How has the recent treatment of Section 174 expenses impacted companies claiming the R&D credit?
Yeah, that's a really good question. So when we first started educating our clients about Section 174, their thought was, well, that's fine. I'm just not going to claim the R&D tax credit anymore. And we had to really tell them, well, that's not really an option, because Section 174 was a mandatory requirement versus the R&D tax credit. That's optional. It's just an added benefit for, engaging in R&D type activity in the country. So unfortunately, there were clients that were upset. They were very upset about, the law that came about as part of the Tax Cuts and Jobs Act. But unfortunately, it did, impact clients that were claiming the R&D tax credit. Before, it was just a tax credit and you could deduct your R&D expenses. So in certain ways, it made the credit a little less lucrative. But in other ways, because they had to claim their Section 174 expenses, it increased their taxable income, which actually made them utilize the R&D tax credit a little bit faster. So it was kind of interesting, depending on the client, seeing how it impacted them individually. But I think from, big picture, most clients did not appreciate the amendments that were made to Section 174. And, especially those that were, slam dunk, they were claiming the credits. We told them that you absolutely need to start claiming your Section 174 expenses, especially the historical. Right. And then the clients that weren't claiming the R&D tax credit, but we knew that they were in industries that, typically engaged in R&D, in some ways it actually made them take a closer look at the R&D tax credit, because the Section 174 claiming those expenses on the return increased their taxable income. And so they were looking for a way to kind of offset that income by claiming a credit. So hopefully that answered your question. But I would say the interplay is, while the expenses are related, they are two separate code sections and two separate areas that need to be considered. And even though the law has changed in that now you can fully deduct those R&E expenses, it's still something that we're evaluating. We actually do have clients that are still like, okay, even though we know that we can deduct those expenses, we actually might still want to capitalize and amortize them. And that's something that we're evaluating with a lot of our clients right now.
Thank you. Good to know. So, and building on top of that, the bill also touches on the R&D credit itself. Any changes to the R&D tax credit from the OBBBA?
There you go. I love it. We can go through every variation of how we can say this.
Yes.
I love it. Yes, OBBBA.
Let's keep it colorful.
Yes, why not? Let's have fun with it, right? So, I will say the R&D tax credit calculation is largely the same. So not much has changed there. But they did make a few small changes, which kind of, I will say most people weren't really focused on that. We were also focused on the changes to Section 174. And now that we've kind of gone through that, digested what the changes are, we're all kind of focusing on, okay, there are some subtle changes to Section 41. So prior, the way the code was written, it said that your R&D expenses may be Section 174 expenses. Now it says they must be Section 174 expenses. So that's something that's kind of subtle and new, and it's brought about a lot of debate in the industry where people are asking, does that mean we need to do full Section 174 studies even though the treatment of the R&D is the same? Or does that mean we just need to list out what the Section 174 expenses are? So we are expecting some additional guidance there, but I think most practitioners are still kind of putting their heads together to fully understand, why was that change there? Why did we go from may to must? There must be something there. And then the other big change is to Section 280C. I know I'm throwing out a lot of code sections at you, Shardae, so thanks for bearing with me there. But
That is okay.
you're very kind. So I'm going to try to simplify this as much as I can. But essentially, the way the credit works is let's go back to pre-Tax Cuts and Jobs Act, right? So when you could fully deduct those expenses, the IRS didn't want you deducting the same expenses that you were claiming a credit for. So you would make a 280C election where you could reduce your credit in light of all the deductions that you were taking for your R&D. But when the amendments were made to Code Section 174, the 280C election really wasn't necessary because you were already capitalizing and amortizing those R&D expenses. You could kind of get the benefit of the larger credit. But now that the rules have kind of gone back to pre-Tax Cuts and Jobs Act, we're expecting that a lot of clients probably will be making that 280C election on their federal tax return and taking a, slightly like a haircut on their credit. But of course, I do think now that most clients kind of by default used to just elect 280C because it was, for lack of better terms, it was a simpler way to kind of figure out what the most beneficial option or kind of a simpler way to claim the credit. But I do think now people are going to take some time to really evaluate, should we reduce our deductions or by the amount of the credit, or should we really just take a reduced credit? So I think it'll be fun. And I think the big takeaway here is that there's just a lot of modeling to do, and a lot of that will continue into the next year and probably in future years. And so those were kind of the big changes to the R&D tax credit from the One Big Beautiful Bill Act. So I just said the full name this time. But
Go ahead. You go right ahead.
But in general, like the IRS has changed their forms for Form 6765. That's the form where we claim the R&D tax credit, and they've added a lot more additional information. And so there's a whole section that requires you actually provide information about the business component, which they waived that requirement for the 2025 tax year. So we have one more year where we kind of can work with our clients to start preparing for when the forms are really full throttle, like in action, where you have to list all that information. But overall, the IRS is now requiring that you put a lot of information, not just quantitatively, but qualitatively about what you're qualifying, what your projects are, and how your projects meet the qualification for the tax credit. So that's something that we're working on with our clients. But there's a lot of buzz in the industry about, are these new, requirements, are they going to continue to stay? Because there has been a lot of uproar about how burdensome it is. Because if you look at some other tax credits, most of those tax credits don't require that you provide all the information that they're now requiring for the R&D tax credit form. So I'm sure next time we talk, I'll probably have even more of an update about that.
Right. And I can't wait to hear it.
I know. The suspense.
Okay, I know. So, and on the capital investment side, businesses have been eagerly anticipating the return of enhanced depreciation benefits. And a lot of people have been looking forward to a return of 100% bonus depreciation. What are the rules related to the bonus depreciation in the One Big Beautiful Bill Act?
I have to say, first of all, it's always funny to hear that, like, oh my God, we have to have 100% bonus depreciation. Because when it first started, like in 2001, it was 30%. And that was after 9/11. So it's like, that seems so major. And now it's like, oh, we can't even deal without 100, Where this last year would have been 40%. So anyways.
Are you saying we're spoiled, Duwayne?
He's
What?
like, hold on,
Are you saying we're
relax.
spoiled that we expect nothing less than 100%?
So yeah, we have 100% bonus this time. And so, since TCJA, we were like in a phase down. So we had 100% through 2022, and then it was phasing down after that. 80%, 60%, 2025 would have been 40%. So we have the 100%. It's permanent. I'll say permanent as long as everybody still likes it, because I'll be talking about in a few minutes a couple of items that won't be permanent. Anyways, the only thing is there are some rules around that, especially when we're in a transition year. So the key date is January 20th, 2025. So it doesn't just say that the items have to be placed in service as of that date or after that date. it says that it needs to be acquired and placed in service, right? So you really need to look at that definition of acquired. So if what the IRS says is if you have a written binding contract before that date, then you actually have to do the prior depreciation rules. So what's a written binding contract? It's a contract that ties you to that purchase, right? So let's just say you contracted to buy a building, right? If you had met all of the contingency clauses, any damage clauses, things like that, you're past that period, then you're binding for that contract at that point. So so they'll look at the date on which that's that was entered into. They'll look at the date that it's enforceable by law. They'll look at cancellation periods, contingency clauses to see if you're tied to that contract or not. And if you are, you'll be under the lower rule, or sorry, the old rules. And if if your date is after the January 20th date, or sorry, January 20th or after, then you'll be under the 100% bonus. And then also you get questions about self-constructed property, because people don't just buy properties, they actually construct them as well. And so for those rules, they actually offer a safe harbor. It's 10% of cost. So that cost would exclude any land or preliminary activities, basically, true construction costs. If you are over that 10% as of that date, you're considered to have started construction, substantial construction before that date, and you're required to use the old rules. So we actually have people so the phase down would have been 40% for 2025 and 20% in 2026. We actually have people that started, construction before this date. They were over the 10%. They're not going to have an in-service date until 2026. So they're going to be at 20% rather than that 100%. Or even, God forbid, which you get large projects, it went into 2027, it would be 0% bonus depreciation. There is some thought that needs to go into that. I kind of mentioned buildings and things like that. If you had someone that was just buying assets individually, if I were a tax preparer, if I saw any large numbers coming through with in-service dates in, say, February, probably would question, like, when was your PO issued? When were you really bound to buying this item? That transition date is really important for the 100%, because it may have been 40 instead.
Okay, thank you, Duwayne. So, and manufacturers in particular are buzzing about a new opportunity within the bill that could significantly accelerate cost recovery. And I'm talking about all the buzz amongst manufacturers regarding a new incentive to write off buildings. I'm sure the listeners would love to know more about that.
Yeah, I'm going to go with the good, bad, and the ugly on this one, right?
Go for it.
Yes. So, that was originally, it was like, oh my gosh, I'm going to be able to write off a manufacturing building. And then you had people kind of stretch, getting these ideas like, am I a manufacturer? So there's some rules that have come through for this. And then there's some questions that need to be answered. With a lot of new legislation that comes out, there ends up being questions, so that's part of the ugly, that I'll talk about. But for the good, we'll say, yes, there is a new temporary allowance. It's 100% for qualified production property. That's based on if you started construction of that property, once again, that January 20th date. The property has to be placed in service by January 1st of 2031. There is a rule that you can use it for used property. So if you buy a property and you acquire it after that January 20th date, subject to that written binding contract, and before the end of 2028, and place it in service before 2031, then you can use the qualified production property. The only rule on those used ones is you cannot buy, because it's supposed to be incentivizing new manufacturing in our country.
Okay.
So you can't buy a building that was previously used for manufacturing, and the dates on that are like January 1st of 2021 through May 12th of 2025. If it was used for production, manufacturing in those time periods, and you buy that property, it doesn't qualify. It needs to be something that you're transitioning over to manufacturing and expanding to manufacturing. So that's the good, right? So there is an option there.
Okay. What else you got for me then?
So then, and I won't call it bad, we'll say the caution.
Okay.
is
Okay.
some of the definitions, right? So qualified production property, it needs to be property that's related to manufacturing, production, or refining of a qualified product, right? And so as part of that, it needs to incur a substantial transformation. So originally I had people like, oh, I have a distribution center, I have a packaging
Mm-hmm.
center, things like that. Those will not qualify because they're not transforming something substantially.
Mm-hmm.
If you had like, I take pieces of furniture and I put it together kind of like a to-do kit, a self-assembly kit, right? That
Mm-hmm.
that's not going to qualify. But if you had that same kind of piece, let's just take a piece of furniture like that, and you put it in like North Carolina where they're actually manufacturing a table or a couch or something, that would qualify. And so when we talk about that, the qualified product that you're manufacturing, it needs to be tangible personal property, and it can't be a food or beverage that's served in a retail establishment. So restaurants don't qualify for that. There was some questions of that originally, like, I'm combining ingredients and transforming. Food manufacturing would work. You just can't have that retail sales on site. So that's some of the cautions, we'll say.
Okay.
And then we get to maybe the ugly. And so one of the items is that if you cease doing qualified production at that facility within 10 years, then you have to treat it immediately as a deemed disposition, and it's subject to 1245 recapture, which means you would have to recapture that depreciation you took, that 100%, at regular income rates. So it's not like a sale with capital gain rates or anything like that. It's recaptured at ordinary income rate. So you really have to make a commitment when you're doing that, and you're making an election on your tax return. So it's very we'll say specific and you're intending to do it. So it would be tracked on your return. Another kind of ugly thing is that lessors who lease property are excluded from using qualified production property. So if I owned a building and I leased it to someone else and they're a manufacturer, I can't take advantage of that. And so where that comes into a difficult situation is, I would say 9 out of 10 clients that I talk to about this, they are in what's called a propco opco situation. So it's common to hold your real estate in a different entity than your business, right? And so what they will is, it will a lot of times be the same owners, but that owner is leasing to their operating entity. That gives them flexibility, like if they wanted to sell the building and lease it back,
Right.
protections as far as legal protection, all of that. So anyways, right now those people would be excluded from that. So we're really waiting on some further clarification from the IRS, since this is newer, because I personally don't think that was the intent, especially given that that's a common way for real estate to be held in this situation. And then the last kind of item that's a negative, and it's not a negative, I mean, it makes sense, is that the qualified production property, it can only be used, that 100% write-off, for the areas that are related to the qualified production. And so you have areas, you think of a manufacturing facility, you have areas that are, admin offices, accounting offices, research and development, like the folks Nina was talking about, the sales department, maybe, all of that. Those are not included in that. So it really would require somewhat of a study to divide up that building to determine which portions actually qualify for the 100% write-off. That's the good, bad, and the ugly on that one. A little bit
Well,
good. I
we
think
survived it.
clarifications will get us to a not so ugly picture, but
Right,
we
right.
definitely need some of those from the IRS.
Right. Okay, and beyond those headline items, the legislation includes several additional changes that companies should be aware of as they plan ahead. So, what else in the OB3, switch it up again, that we should be aware of related to depreciation and expensing?
So the last three, so 179 expense. So, that predominantly had been for smaller taxpayers, and it allowed them to certain types of property. So it needed to be personal property, or there were certain limitations on real property like roofs, HVACs, security systems that you could actually just go in and write off. And it's similar to 100% bonus, but a little bit different. 100% bonus is more any property 20 years or less, where 179 expense is specific assets. And then so they kind of overlap a little bit, but then there's also some items that are included in one and not in the other. Anyways, that deduction had been $1 million, so it has been, or that expense has been $1 million. It's been increased to $2.5 million. It does have a phase out, so if you buy $4 million in that type of property, then dollar for dollar over that, it phases out. So once you get to like 6.5, you can't use it at all. So a nice thing on that is it doesn't have that January 20th date. It basically says any assets in 2024, you can use these new rules. And then OBBBA, so we talked about the qualified production property. You'll kind of see a shift through this, this legislation away from maybe some of the energy incentives and over to more like just pure manufacturing. And so as part of that, to free up money to then go back to manufacturing, there were some cancellations of energy incentives. And two of them related to buildings, particularly our 179D. That's a deduction for energy efficient commercial construction and apartments 4 stories and above. So that is sunsetting. You will have to begin construction on those properties by June 30th of 2026 in order to qualify for that deduction. That one, I will say, was permanent. So that's kind of my example of things could be permanent and then not. So, you know, it came out back in 2000. It's an Energy Act of 2005. And so it had been extended like kind of year by year and sometimes retroactively extended. And then in 2020, which ironically was still a Trump administration, was made permanent. And then, you know, now here we are again and it's been taken out as not. So, and then 45L was a credit for energy efficient residential construction. And that actually, properties have to be sold or leased by June 30th of 2026. Or else they don't qualify. So you'll have a lot of like, say, apartment projects, people like that trying to get, if they had decided to use that program, it requires Energy Star certification. You'll see people trying to get those things leased up or sold by that date so that they can still qualify for that credit, because they may have kind of prepped up their project. They're kind of long-term projects sometimes. If you think about like a big apartment complex, 2-3 years sometimes to build. Where they're building it to that requirement for that credit, and then June 30th, if it's not leased or sold by that date, then there'll be no credit there.
Please pay attention to the dates and the deadlines.
All the dates.
Oh, did you say something, Nina?
No, I was just saying, paying attention to all the dates. I know there's so many different dates depending on what code section you're looking at. So it's really important to look at that.
Big ones were the depreciation, that January 20th of 2025, and then for the energy incentives, June 30th of 2026.
Just definitely have to pay attention to dates. It seems like every provision has a different deadline, so definitely having to keep track of a lot of different things.
So that wraps up today's conversation on this episode of Beyond the Ledger. Thank you, Ben, Nina, and Duwayne, for the in-depth conversation on the impacts of the One Big Beautiful Bill Act. And I can't wait to have you all back. Thank you so much for being here.
Thank you. It's our pleasure.
Great to be here.
Thank you.
Thanks.
That wraps up today's episode of Beyond the Ledger. A huge thank you to Ben Bowers, Nina Desai, and Duwayne Sibley for breaking down the One Big Beautiful Bill Act and giving us a clear understanding of how these new provisions impact taxpayers, innovators, and businesses across the board. Their insights offer a practical roadmap for navigating change with clarity and confidence. If you found this episode helpful, be sure to follow or subscribe so you never miss an episode. And to learn more about Bennett Thrasher's tax planning, credits and incentives, and broader advisory capabilities, visit btcpa.net. We'll be back soon with more stories and insights from the experts shaping the way organizations plan ahead, uncover opportunities, and move forward. Thanks for tuning in to Beyond the Ledger. We'll see you again for the next conversation.